Hey everyone, it's Larry Berman here. Another crazy week on markets. The grinding bid persists. The Energizer Bunny just keeps firing on all cylinders here. When is it going to end? Biggest question I've heard from friends, clients, social media this week, and the answer is I wish I knew. But it'll end when it's over. And I hate to be flippant about it, but that's the reality of markets when they get into this part of the cycle. There's really no telling. I am seeing upgrades to some really crappy companies out there, so analysts are having some fun, I guess. And speculators are running rampant. Goldman Sachs put out a piece on the quality companies relative to the speculative companies and what's going on there. And clearly the money is really ramping up on the speculative side now. So that's the environment we're in. Anyways, let's take a dive into the chart room and see what the government shut down if we learned anything this week. So no non-farm payrolls this week. So we had the ADP report come out, and when you really look at what's going on there, it's pretty clear there's a significant decay overall in the labor force situation. But we don't know what the official numbers are, and that's probably something that we'll get, a week or two after the government reopens again. And maybe there's actually no payroll report for this month and they just do it next month. So I don't know what the plans are there, but ADP is telling us the demand for labor is soft, very, very soft. But the initial claims, which we also didn't see this week, tells us that we're not seeing mass layoffs. And this part of the cycle is Goldilocks in the sense because we're not seeing the layoffs and there's really no reason not to, stay invested in equities because the weakening labor picture is prompting the Fed to, cut rates, and the market loves that. So we're virtually certain right now that we'll get a 25 basis point cut on October 29th, and then on December 10th, almost virtual certainty again that we'll get a second 25 basis point cut. But the pace of cutting after that really starts to slow, with really through all of next year only two more cuts coming. And that speaks to the inflation risk that's there. It speaks to the messaging that we're hearing from most of the central bankers at the moment, although certainly not Stephen Mirren, who's out there saying they need to go more aggressive. And we'll see what happens. We should know in about a month who the new Fed chairman nominee is going to be as well, and how aggressively dovish that person may or may not be. When we look at the prospects for Canadian rate cuts, one more not even fully priced in for the rest of the year. So the weakness in the Canadian dollar here should be reversed. We shouldn't see it drift too much weaker here. Little bit surprised on that, but you get caught up in the dollar sentiment and the cross currency sentiment of a weaker U.S. dollar at the moment because of the rate cuts that are coming, more so in the U.S. than in other places who were previously much more aggressive on rate cutting, including Canada at this point. When we look at the leadership, so BAI is the iShares AI innovation and technology active strategy. So this is an active approach to the AI sector compared to the artificial intelligence and technology ETF that I've talked to about for quite a while, AIQ, as the more indexed way to play it. And as you could see, the active approach has more volatility, better when it's good, worse when it's bad, better when it's good. So it tends to be overweight the names that money flows into when things are good, and money flows out of when things are bad. So that's the story between those two ETFs, both still outpacing the NASDAQ, red line here, and the S&P 500 over that similar timeline. It only goes back into 2024 because that was the beginning of when BAI started, and so we'd have no history before that. Again, active strategy, so there's no index that was tracking to go back further. But keep those two ETFs on your radar. I like them both. I would think that pullbacks in the space, corrections, and at some point we're going to get a doozy, is something you want to be adding into those names. The former gold leadership proxy, Bitcoin, is not breaking out here, although it had a really good week up against the previous highs. So critical week here. Can it break out, or does it fail back into the range? I'd be betting on a failure here, but we'll see how it plays out, because what's happening in gold is clearly not higher highs, higher lows. Trend is still there, is very strong. One of the comparisons I wanted to make here was coming out of the GFC and looking at that rally in gold in terms of what it meant from a percentage return perspective. We went from 700 at the low to a little over 19 at the high. Not quite a 3x, but pretty darn close. If we measure the base, length of the base onto the breakout, if we take that as another base, where is this likely to end? So if we take that same almost 3x from this low, we've already blown through that. So what is the right measurement to equate to that? There really isn't any. The breakout did happen. It got up to that high from 2011, and we consolidated sideways. What is almost certainly going to happen at some point here is we're going to get a multi-year consolidation in gold. Maybe the new base is between 3,000 and 4,000. I don't know. It's certainly going to be above 2,000. We could get a correction of that magnitude in the right circumstances. Better fiscal government isn't going to be one of them. So what's going to cause the correction of that magnitude, I don't know. I don't think that we're in for that type of correction. But a move back to this base at some point to check the breakout. We never really got that from the 2000. It kind of broke out and never really came back to test. So at some point, we're going to get some downside here. If we blow this up a little bit more, the real pain probably comes with this base here breaking to the downside. So I think that will come in the next correction. I just don't know where it's going to start and what the catalyst is going to be. Clearly, there's nothing in the charts here whatsoever that would identify that, with the exception of saying Bitcoin can't go. Maybe a lot of that money that was going Bitcoin is going gold now. I'm sure there's some of that as well. Anyways, that's kind of what I gleaned from the markets this week. Have a good one, everyone.